had a question around looking to buy an apartment in Adelaide CBD, returning $540 weekly rent, and it's a $270,000 purchase. Would you advise to invest in this property? All right, so without digging into your circumstances, I will just probably give a broad framework for assessing this type of deal. So just on the surface, the rental yield is very strong. So, 10% rental yield, and the price point is very affordable, under $300,000. So to get a comparable property that is a house in Adelaide, and I won't look out to other parts of the country, but, if you were targeting a house for $270,000 in Adelaide, you would be having to go right into the northern pockets of Elizabeth, the outer rings of the lower socio areas. And for under $300,000, yes, it's still possible in 2023, but for under $300,000, you would be expecting a 6 to 7% yield, and it's going to come with a compromised street profile. 15% plus public housing, low owner-occupier levels, very low gentrification drivers, and high associated crime and low socio impacts. Okay, so for your $270,000 in a house in Adelaide, your yield is going to be, a 30-40% reduction, and you're going to have very strong associated social impacts. So your capital growth profile is going to be compromised for that. Okay, with low owner-occupier levels, particularly in those streets that will be at that price point, you would expect, low owner-occupier demand is strongly correlated with low capital growth profiles. So you're actually probably not gaining anything from buying that house compared to this unit in terms of capital growth. So with that alone, okay, without the capital growth, let's just say for a moment, the argument and assumption here is that units don't grow strongly in value. Buildings depreciate, land appreciates. Units typically over time in Australia haven't performed as well as houses. But to get the same house at the same price point in Adelaide, you would have a very strongly compromised growth profile. So here, let's just draw a line in the sand and say the capital growth for both of these assets will be similar. But the unit block yield is 10% here versus 6 to 7% for a similar house. So on that alone, I would be very comfortable with this investment if the yield is your requirement. I also then ask, there are some got-yous with units. You've got associated body corporate strata fees. That could end up being 1, 2, 3% per annum in terms of cost base associated, bringing your yield down in real terms to 5, 6, 7, 8% right there, just on that extra cost associated with units. And you may have, less maintenance, but then you might have those higher body corporate strata fees that offset things. You might have, I'm assuming it's going to be quite a small floor plan as well, Adelaide CBD at that price point. It might be a 1-bedroom or a studio apartment, under 50 square metres. A lot of the big four, a lot of the more competitive interest rates are off the table. Okay, they don't like lending to smaller, floor plans, and there's a lot of rules around lending. So you may have high interest rates associated with this acquisition. If it suits you, if you are driving for yields, 10% yielding is a great starting point. If that is all you need in an investment, then potentially this is worthy of your attention. But I would challenge you in terms of what could $300,000 get you in other parts of the country, because you have to look at the overall return on investment. And that is from value add opportunity, it is from net rental yield, not gross, and from then capital growth. That is your total package. That is how you make money from this property. And for $300,000, I'll potentially be looking at regional Queensland. You'll be getting a 6.5%, 7% yield, but very strong, best in the country capital growth profiles. 6, 8, 10, 12% per annum capital growth for the next 1 to 3 years. Okay, that's what we'll be looking at and expecting with that 5, 6, 7% yield on purchase. So for me, if you don't care about money, you don't care about capital growth, then potentially this is a great low maintenance, high yielding investment. It might work well in a super fund, etc. But for me, I would expect more from my investments. I wouldn't fall in love with this yield. I would look for a high yield with a very strong capital growth profile. And then you might say, well, it's going to my super fund. That's all good. I just want low maintenance. It's great to have capital growth in a super fund. You can sell down in a super fund. You can take profits, refinance in super funds. So unless you're wanting to retire tomorrow on the income from your super fund, for me, my strategy in my super fund is building a legacy, equity, capital growth, a nice net worth position in that super fund, and then diversifying or divesting into higher cash flow producing assets when I need the cash flow in that super fund. Until that date, my number one priority in self-managed super fund is to generate net worth, right? You can refinance, you can sell down. So for me, I would expect more from my investments on that. I love the yield, excellent, but I would probably look more to a more holistic return on investment, particularly including capital growth. Regional New South Wales, regional Queensland, particularly at that price point. You've got some, Rockhamptons, Bundabergs, even parts of the Mackay area, cyclone insurance policies there may be a bit of a risk that are still very accessible at that price point. I'll challenge myself to look there. All right, guys, if you're loving this content, you want to join in the conversation, then head across to our High Performance Property Investment Facebook group. Over there, we digest these videos, we pick them apart, and we also talk about alternative scenarios. So jump over there, apply to join, and we'd really love to welcome you to that community.